So for more on September's swings, we're going to get to Jeffrey Kleintop. He is Charles Schwab, Chief Global Investment Strategist. Jeffrey, it's great to have you on here. So talk to me about how you are approaching the dip that we are seeing right now. Is this a buy-in opportunity for you at the moment?
Well, I think you want to watch the yen for clues on the tech trade here. I mean, going long on tech and short on the yen have been two very crowded trades in recent years, and for good reasons. The yen is the cheapest funding currency in the world, meaning you can borrow cheapest in yen, and tech's been consistently profitable. So it's not hard to imagine that a good portion of the short yen trade flow has gone into U.S. tech as a cheap source of leverage. Asset managers have borrowed nearly $1 trillion in yen to invest some of that in tech stocks. So there's still a very strong link between the dollar yen and tech stocks. And we can see that even this morning with tech continuing this sell-off and the yen higher. I don't think we're completely done with this yen carry trade unwind, even though yen contracts have shifted from net short to net long. We've still got a lot of asset managers with a lot of exposure to the yen that continue to unwind those tech stocks. I think that's going to hang over us for the remainder of the year.
Okay, and unwinding of tech stocks is good for what other sectors, Jeffrey?
Well, I think it benefits sectors that are undervalued and underowned. I'd look to sectors like financials, energy, and materials. They're attractively valued, they're underowned, and benefit from the promise of Fed rate cuts and a weakening U.S. dollar.
What does that mean for you in terms of where you are finding defensiveness amid that backdrop? And I'm curious specifically about how you're thinking about the tech sell-off that we've been seeing over the past couple of days here. Is that something that you think is going to define the market trade for the second half of the year here, or is that just a little bit of September seasonality?
Well, I think it's more than September seasonality. We're seeing this show up in the entire third quarter. You know, it was interesting. In the second quarter, the average stock in the S&P 500 was down while the overall index was up, and that's simply because of tech's leadership. The opposite is happening this quarter. What we're seeing is the average stock in the S&P 500, look at the equal weighted index, is outperforming the capitalization weighted index. So we're seeing strength outside of tech. That's been our story about the second half of this year, a broadening of the market. Again, focusing on sectors like financials that benefit from some of the trends we're seeing right now that may offer some defensiveness in the face of this lingering pressure on the tech sector.
Some continued contraction shown in the ISM manufacturing data that we saw come out yesterday, Jeff. Plus, we're going to get job openings, labor turnover survey here today, and then, of course, the all-important jobs report. This seems like a very similar setup in terms of the market reaction in early September as we saw in August. However, there's the additive of what we see in seasonality during September. How much volatility do you think that reinserts back into the equation here?
Yeah, it's certainly a risk. There are a lot of factors setting up, and we've also got the looming election, right, coming up that adds more risk as we get closer there to volatility in the markets. One thing I'd say that's different is that in early August, speculators like hedge funds were net short 190,000 yen contracts. That's near $16 billion in short yen. They were forced to close out all those trades rapidly, meaning selling off stocks like tech and buying back the yen. But now they're net long 26,000 yen contracts. There isn't the same vulnerability for a short-term shock to markets on some of this weaker data. Even if the jobs report comes in softer, the JOLTS data today, some of the other data suggests the Fed might shift towards a 50 basis point rate cut from our expectation of a 25. Don't expect the same type of reaction. Yes, I'm still worried long-term about this yen carry trade unwind, but in the very near term, the vulnerability to a shock is much lower than it was in early August.
So when we circle September 20th in our calendars here for that next Bank of Japan meeting, how big of a red mark should I put on that day to prepare for the show? How big of a potential issue is that going to be for markets that day?
Oh, it'll be a major focus of the markets for sure. I don't think that the Bank of Japan is backing away from rate hikes. I think they're going to continue to hike rates, probably the next one around the end of this year or beginning of next year. And that's on a path higher at the same time the Fed is on a path lower. So this is going to continue to be an issue for the markets. Also on September 20th, that's right, that is the BOJ date. That's also the date that we get the date at which the countries in Europe that are subject to the excessive deficit procedure, this is France and Italy now, are being forced to constrain their budgets. They've got to have their fiscal plans filed on that same date, September 20th, and that could provide market participants with a catalyst to position for tighter fiscal outlook in both of those countries, which could actually strengthen the euro versus the dollar, in addition to the Bank of Japan meeting strengthening the yen versus the dollar. So that could be a big day for markets.
Yeah, it could be either for that week, a series of fortunate or unfortunate events as well here. As we know, September 17th and 18th, that's going to prelude what is taking place in Japan with the U.S.'s FOMC meeting as well. What is the tenor that you expect to come out of the committee members, not just for their decision that is expected at this point, and it has been essentially telegraphed to be a 25 basis point cut from what we expect, but about further cuts and that pathway going forward from here?
I think we'll hear more emphasis on the job market. We certainly got that out of Jackson Hole, and I think that is the message that the Fed wants to convey, that they are now maybe even more concerned about the job market than they are about the inflation picture, declaring a little bit of victory over inflation and focusing on jobs. So much of the tone of that meeting on the 17th will be decided by what we hear this Friday.
All right, Jeffrey Kleintop, who is Charles Schwab, Chief Global Investment Strategist. Jeff, always a pleasure to grab some time with you. Thank you.
Thanks for having me.